let's just hop into this first report from Berkadia. Interest rates, stagflation, inflation, and monetary policy. It seems like everybody's talking about the Fed right now.
Yeah.
It's obviously, which is for good reason.
Yeah.
Who can move the needle? It's the
It's
Fed.
nice when we have a confluence of some of the reporting that comes out, because the Fed is a perennial subject of long-term attention. And there's been reports from Berkadia. There's also been a short video that Marcus and Millichap that released that covers roughly the same subject.
Yeah.
And I want to go through this one also because we have an upcoming interview with the Berkadia Thought Leadership team next week. And part of this is what we'll cover in the interview. But there really is enough in this study that I can be digging as much as I can into this, and it'll still be just a teaser for
Perfect.
what
I was going to say, we got to save the good stuff for Jonathan and Noah, but also, as you said, Matt, we got this is a
well. Good news is
report.
There's a lot of stuff in here that it takes me a few minutes to wrap my head around, and so I think our average listener will be fine. But I got to do some thinking time. Fortunately, though, at the start of this report, the authors Jonathan Rappa and Noah Stone have a solid breakdown and explanation right off the bat. They have this executive summary that the first point of which is that monetary policy changes take 5 to 6 quarters to actually have an impact on leveraged apartment returns. Yeah, there's that first page there. Now, this may not be a huge surprise to people, and it's likely something that you'll find out if you throw the numbers in a spreadsheet. But the reporting on monetary policy, and to extent the feeling in the multifamily markets, we heard back from those surveys last week. Everyone, their chief concern in I think even Berkadia's Powerhouse poll was inflation policy, monetary policy. How much is that going to affect the market?
Yeah.
But so with that in mind, though, even so, there's this feeling that the monetary policy has so much more immediacy, how there's going to be this instant effect. But what they're saying here is 5 to 6 quarters. That's going to be a year and a half before
maybe
really
in the stock market. Public equities market that are forward-looking indicators. Real estate is a lagging indicator. That's for sure. Which again, that's why real estate is so exciting, is because you can exploit these inefficiencies. You can use indices like the stock market or the bond market just to get an idea of kind of the general sense of the economy. And then real estate moves so much slower. You can have an idea of the future to make some different interesting calls, whether for good or the bad.